Welcome to this short executive knowledge lecture on topic 4, paper 7 of the SFC licensing exams. This topic covers the debt market, and we'll be looking at characteristics of debt, categories of debt, categories of bonds, the fundamentals of pricing debt, the role of the yield curve, and certain aspects of the Hong Kong debt market. I will emphasize the important points to help you understand the core material you need to know to sit the paper 7 exam. Now, a copy of the study notes that you see on the screen can be downloaded from the Executive Knowledge website under Paper 7 Resources. And as ever, I strongly recommend that you supplement this learning with question practice, and we have uploaded more than 300 practice questions for Paper 7 on the Examinator.online platform. So what have we got? We start with considering what is debt. Well, I think everybody knows what debt is. We actually put it into English and the concept of debt securities. What are the advantages of investing in debt securities? Well, lower risk than equity in normal circumstances. We get usually a fixed income, the coupon, and that is stable and predictable. And it's usually a higher yield than bank deposit rates, although you are taking a certain amount of risk in that. With corporate bonds, the issuer can, or hopefully doesn't, but could default. What are the characteristics of debt? Well, we've got short-term versus long-term, and 1 year is the critical time frame. So maturity is less than 1 year, the debt is considered short-term. More than 1 year, it's considered long-term. With the calculation of interest, it will depend on whether the rate is fixed or floating, the payment period frequency, and whether the interest is simple or compound, and we'll consider the different types of interest in a moment. Debt can be secured or unsecured on underlying assets. If it's an unsecured loan, there is no security guarantee. Repayment structures can vary. You can have an amortizing debt where part of the principal is paid each period, or the principal is repaid at maturity. Currency. Now, bonds or debt can be issued in different currencies. And we have particular names for bonds, for debt that's issued in particular countries by overseas issuers. For example, Yankee bonds are where you have US dollar denominated debt issued by non-US issuers in the US. So that would be where you have Japanese companies issuing US dollar denominated debt. Those would be referred to as Yankee bonds. Similarly, Bulldog bonds is where the debt is denominated in pound sterling, but it's issued by non-UK issuers. Samurai bonds, the equivalent for Japanese denominated bonds, and Panda bonds are issued in renminbi by non-Chinese issuers mainland. Easy to examine those different types. And then another characteristic of debt is where the debt has underlying options. 3 types: callable, puttable, convertible. A callable bond is where the issuer of the bond has a call option, that is to repay the debt, an embedded call option. Whereas a puttable bond, it is the holder, the investor, who has the right to sell the bond back to the issuer, and we refer to that as an embedded put option. And then convertible bonds, where the holder has the right to convert into equity shares, or indeed it could be other debt instruments. And if bonds not converted, then the issuer must redeem on maturity. Moving on to interest rates, the calculation of interest rates. Yes, you can get a question or two on this, and usually it is a enumerative question, calculation question. Now, simple interest is just that. It's simple. The interest is calculated on the principal each period, but in calculating the interest in subsequent periods, the earlier interest is not added to the principal. Let's have a look at a simple example in the box. Calculate the amount of simple interest and the total amount obtained maturity on a deposit, 500,000 Hong Kong dollars after 4 years with an interest rate of 3%. Now, what this is saying is you get 3% annual interest for 4 years on the 500,000, but the principal does not grow. So we do the calculation, it comes to 60,000 Hong Kong dollars. We add the 60 to the initial deposit, and the amount of the deposit at the end of 4 years will be 560,000. Now, an instance where this may be helpful is in a question where you're asked to calculate the amount of a deposit on maturity when it's compound interest. But a shortcut to the question is to quickly do the calculation using simple interest, calculate what the amount will be on maturity, and the compound interest answer must be greater than the simple interest calculation. So that's just a tip, and we have some practice questions that cover that point. Compound interest, on the other hand, is where the interest each period that is earned is added to the principal, and subsequent interest calculations are on the higher principal amount. Now, the formula at the bottom of page 3 here, the amount received at maturity, well, we take the loan principal multiplied by 1 plus the interest rate. What is the interest rate? It's the interest rate per period divided by the interest payments per period. What on earth does that mean? If the interest rate is usually expressed in annual terms. So if it was, let's say, 6%, and there was 2 interest payments per year, that is semi-annually, then you would take 6% divided by 2, it would be 3%, 1.03. And you multiply the loan principal by 1 plus the interest, 1.03 in my simple example, and you multiply the number of times that payments are made. That's why we're raising it to the power periods multiplied by payment per period. Let's do an example, the box top of page 4. $10,000 invested for 3 years at compound interest of 10% per annum. What will the deposit be worth at the end of the 3-year period, and how much interest will have been earned? Well, we're using the formula that we introduced in the previous page. FV, the future value, is equal to 10,000, that is the deposit, multiplied by 1 plus the interest rate. Now, we've done it in the full version, but you can see where the period, the number of payments per period is 1. It is just 1 plus the interest rate of 10%, and we raise it to the power of the number of periods. Well, there are 3 periods, 3 years. That then boils down to 10,000 multiplied by 1.1 raised to the power 3. Now, how do we do that calculation in the exam? Well, you can either use the y to the x function on a financial calculator, or you sit and bash in 1.1 3 times into the calculator, and you will get 13,310. So if the deposit is worth 13,310 at the end of 3 years of compound interest, and we started with 10,000, the interest element must be 3,310. Moving on to different ways of quoting interest rates. We're told there are 3 common methods of quoting. Nominal interest rate, the most common method, and that is where we're just told the face interest rate. The nominal interest rate will be a combination of the real interest rate, the real rate, and inflation. That takes us on to this concept of real interest rates. And real interest rates are the rates that exist in the economy before we take account of inflation. Now, if we want the exact nominal interest rate, we have to take into account an element of compounding. And the formula is 1 plus nominal rate equals 1 plus the real rate multiplied by 1 plus the inflation rate. A shortcut to that is the nominal rate equals the real rate plus the inflation rate. Now, which of those 2 methods you use will be determined by the wording they use in the question. So if they ask you for the approximate nominal rate, approximate real rate, approximate inflation rate, you just use nominal rate equals real plus inflation. But if they ask you for the accurate or the exact rate, then you use the formula we're looking at, 1 plus nominal equals 1 plus real multiplied by 1 plus inflation. Now, effective interest rate includes the effect of compounding. So we go beyond the nominal rate. And the formula you can see there is that the effective interest rate is 1 plus the nominal rate divided by interest payments in the year raised by the payments per year, which is similar to the compound interest formula. Now, this can come up in the exam, so be aware of this methodology in the box, the bottom of page 4. Effective interest rate example. Calculate the effective annual rate, EAR for short, for the following 3 nominal interest rates, 5.5, 5.75, 6%, but they're paid monthly, quarterly, and semi-annually, respectively. So what's the 3 answers? The 5.5%, that's the nominal rate paid monthly. What is the effective annual rate that we are receiving or paying? It is 1 plus the nominal rate of 0.055 divided by the number of payments in the period. Well, there's 12. So 0.055 divided by 12, and then we will raise that to the power 12. That is 1 plus the 0.055 divided by 12. That will be raised to the power 12, and then we deduct 1 to get it back to a rate, and that comes out to be 5.64%. Similarly, the 5.75 paid quarterly, the interest calculation 0.0575 divided by 4 raised to the power 4. That gives us 5.88%. And the 6% paid semi-annual, it's 0.06 divided by 2 raised to 2. You can see the pattern. Now, again, in the exam, what do I do? Well, it's well worth your while getting a financial calculator that is permitted to be taken into the exam and learning the y to the x function, because it's a lot shorter than, for example, the interest rate paid monthly. If you were just doing the multiplication on your calculator, you have to do it 12 times, and that's fraught with problems. So I would strongly recommend the use of financial calculator for calculating effective interest rates. Different categories of bonds. 3 basic types. Fixed rate bonds, and that's where you receive a fixed rate, fixed coupon through the life of the bond, and that's the most common type in Hong Kong. Floating rate bonds, the interest rate, the coupon, will move with regard to a reference rate, usually the local interest rate in Hong Kong, HIBOR, in the UK, LIBOR. And then zero coupon bonds, just as it said, you are not paid a coupon. The bond is issued at a discount. So let's say you buy a $1,000 bond for $900. You hold it for a number of years, and then it's redeemed by the issuer $1,000. The difference of $100 is the interest you have earned over the life of the bond. So a zero coupon bond has no coupons, but it is always issued at a discount to face value, with the full principal being repaid on maturity. Now we come to pricing of debt, and we look at the time value of money before we get into the pricing. Now, time value of money recognizes that money that is paid or received in the future is not worth as much in today's terms when we receive it in the future. This introduces 2 concepts, the concept of compounding, which we've already looked at, and then discounting. And the discounting is the important point that we need to be aware of for pricing of debt. 2 simple examples that are listed here. We have $100 now, and we're going to invest at 11% per annum. What will it be worth in 1 year's time? It will be worth $111. How do we get that? It's the compounding formula. Future value equals present value multiplied by 1 plus the interest rate raised the number of periods. And as you can see on page 6, that comes to 111. But if we are working backwards, that is, If we are to receive $111 in 1 year's time, what is it worth today? If we discount it back at the relevant interest rate, we just go backwards. So the present value is equal to the future value divided by 1 plus interest rate divided by periods in the year. And as you can see, that comes out to be 111 divided by 1.11 raised to the power 1, which comes out, as you would expect, to 100. Now, this discounting feature is vital in bond pricing because the price of a bond is the present value of the future cash flows, and the future cash flows are the coupons and the redemption of the principal amount, and that will be covered next.